those is two questions. Was why were they using options in this particular instance? And then why were they picking that exact option? The top guys in the world, top 1% of guys, and we're talking about the Bill Ackmans of the world, Carl Icahns, Leon Cooperman, George Soros, Steve Cohen, all the big guys, the guys that you hear that run the big hedge fund shops. This stuff might, Micron could just shoot up. And so do you want to buy stock? Sure, they're probably buying stock as well, but they're buying stock and they're leveraging up with options.
Hello, everybody. Welcome to Traders MindChat, where we talk to professional traders from around the world to get into their mindsets, how they think, how they do, what they do, why they do what they do. And today we are blessed to speak with Felix Frey. I have met Felix a couple of times now, gone through his material. Options can be very complex from most of what we've seen and read and hearing about black shoals and things like iron condors and exotic types of ways to trade options. After talking to Felix, I've come to realize that a lot of that is garbage, that's not how the people that the top 1% are trading options, period. And Felix has a much better way for us to be trading options. He's learned this from some of the top traders in the world, Steve Cohen, a number of others. It's just absolutely incredible what Felix has put together, the education, the tools. I can't say enough great stuff about this guy, and I'm just thrilled to have him here on the show.
Great.
Welcome.
Thank you for having me, Mike.
Yeah, so let's hear a little bit from your perspective of how you tell us a little bit about your backstory. I know that I gave a little bit of...
Sure. I grew up in Queens, New York. Went to school in Philadelphia at the Wharton School at the University of Pennsylvania. In 1995, I graduated and went to work at Swiss Bank O'Connor. And O'Connor was known for two things. Basically, they were the best at options, the best options firm, and they were very, very smart, and they made a lot of money. Okay, so these guys had a great training program that many of the bigger options players on the street had gone through, and I was lucky enough to join that group, and that was my first job on Wall Street. A few years later, I was recruited back to New York. I was in Chicago, back to New York, worked at Bank of America, and that's where my experience really took off. I joined a smaller group within Bank of America, and that group was the equity derivatives group. I was part of a team that on a day-to-day basis spoke to Bank of America's top customers, which, as you can imagine, are the biggest guys in the world. And my job specifically was to advise. At first, it was to advise the top hedge fund managers in the world. And then it was ultimately to trade. I switched sides to the trading side to trade against them. So Bank of America is one of the largest investment banks in the world, top ranked, like a Goldman Sachs, like a JP Morgan, a Morgan Stanley. And part of their business is to facilitate customer trades for the big hedge funds. What does that mean? That means when a guy like Steve Cohen or his firm, or any Bill Ackman, Carl Icahn, they don't go to TD Ameritrade, Robinhood, or they call up one of the top investment banks. And at the top investment banks, you have this group which I was a part of, and they pick up the phone and they basically try to get that order on the tape. Now, what does that mean? That means when, let's just call it, Steve Cohen wants to buy 5,000 calls in a particular name, he's not going to get the price that he wants from just going to the floor and trading with the market makers, because they will ride the price up on him. And so what he does is they go to one of the investment banks and they ask for a price. They say, I want to market, or I want to buy 5,000 calls in Apple. And you have a couple of minutes, and you can ask them a few questions. You got a couple of minutes to either to make that market or pass. But when you're working at Bank of America, one of the biggest banks in the world, you're expected to make a market for them to help them get their trade on the tape. And that's essentially your day-to-day job, to make sure that the customers are coming in the door, they're trading with Bank of America. And on the Bank of America side, Bank of America from the top down is saying, don't lose any money, right? So make sure they come in the door, put up Bank of America's capital, the billions of dollars. So we're going to arm you, Felix, with $1 billion. Make sure the trades come in, but don't lose money. So you're stuck between a rock and a hard place because you're dealing against the best traders in the world, and the bank is asking you not to lose money. So how does that situation exist, right? Before going on to where I went to hedge fund, that situation exists because both parties can make money. Because at that time, Steve Cohen is trading the direction of the stock, and I was trading that time volatility. So that's where I was a volatility expert. Fast forward a few years, I went from Bank of America, switched to a hedge fund, one of the top hedge funds over the last 30 years, working for two great managers and great risk reward options traders. And their fund at the time was $4 billion. So I went there as a head options trader, and I had a big learning curve because I went from being an expert in volatility trading, to understanding how they used options, which was very different. And that was eye-opening for me, because that was the moment where I realized, wait a second, when you're on Wall Street and you're part of the investment banks or part of only a select few hedge funds, you trade options a certain way. That's the only way you understand trade options. That's how everyone teaches it. But when you're on this side, and I'm dealing right now, I'm sitting right next to two of the most respected managers in the last 30 years, and they are not looking at options the way I have looked at it for 10 years. It was a little bit odd. It was an odd experience at that time, but it was fascinating. It was fascinating.
Why do you think that happens? Like, why did he tell everybody else to trade one way, and then these guys are trading a completely different way?
Yeah, so here I was the expert in options, yet I had no idea what they were doing. And to be honest, and to be frank, while I was at the investment bank and I was dealing with guys, there was always this question, there was just two questions, was why were they using options in this particular instance? And then why were they picking that exact option? And, over the years, I didn't really look at the retail industry. I was so entrenched in the institutional industry. But I knew that the number one question that most hedge funds were asking that didn't know sort of the answer or new to options was, Felix, help me choose the right option. Or like, help me with this options game. How do I choose the right option? And that's a tough question.
To you to answer that question.
I was the expert. They were asking me to answer that question. And I could say that I didn't know the answer, right? Because the problem lies, there's a problem with the whole industry. So let me start by saying, eventually I went to Skog and I spent almost a decade there. And then I started focusing on the retail industry and started realizing that, wait a second, there's something really wrong here. The industry got it really wrong from the very beginning, from 30 years ago. Not saying that the Black-Scholes formula is wrong, but all the education, the foundation of the options industry might be wrong, might be misdirected, and it might be incomplete, right? Because if I'm the expert and I can't answer a simple question like, which one should I choose? Which one should I buy? Which option should I buy? How is the average person going to be able to answer that question? Think about what I'm telling you. I'm telling you that let's figure out, let's first tell you how the top guys in the world use options, okay?
Yeah.
The top guys in the world, top 1% of guys, and we're talking about the Bill Ackmans of the world, Carl Icahns, Leon Cooperman, George Soros, Steve Cohen, all the big guys, the guys that you hear that run the big hedge fund shops. They're thinking about options as a risk reward tool, okay? Right. And embedded in that tool, options, is a function called limited liability.
Okay.
That limited liability allows you to get leverage. Leverage simply means in finance, you can place $1, you can invest $1, and that dollar could grow $3, $4, $5. So the reason they migrate to options is because of that limited liability function, that leverage, that ability to gain leverage. The top guys in the world, for the most part, want to buy that tool. They want to buy that option, okay? Because of the leverage. Now, in certain instances, a guy like Warren Buffett, he sells that leverage. He's an insurance company. He sells that, but he does it in very specific times, right? So he sells put options in the big world indices and in the S&P at the time when the market's crashing near the lows, and he says, the volatility is so high and I'm just going to sell it because the premiums are so high. Okay, so that's one way. But on a day-to-day basis, the big hedge fund guys, they're buying that liability. They're the limited liability function. They're buying that leverage. So that clears up a lot. They're buying options. Now the question is, two questions, and this is the only two questions that's going to separate Mike and everyone watching from the top guys in the world regarding options. The question number one is, when do I use options? Because not every stock idea is an options play. So when do I use options? And then once you get through that, the next question becomes, which one do I buy? Right? And so that understanding, the knowledge and understanding when and how do I choose, that's edge. Because if they know how to do that, okay, they are extracting this limited liability function and they're using it to their advantage. Okay, what are most people doing? Frankly, most people, I would say more than 99% of people are guessing. Okay, now let me ask you this. If you're playing a probability game, any probability game, how do you play a probability game? Heads or tails is a probability game. The casinos have probability games.
Right.
Okay, so it's not, people tend to look at options. They say, well, I can buy this option, and if I'm right, wow, look at this, I can make 10 to 1 or 20 to 1 or 30 to 1. I just read an article about a kid on Reddit, took $1,000, turned it into 150,000. It went viral. And I thought, well, you know, that's going to happen. It can happen. The question becomes, I want people to understand that you can't look at something and say, you know, this is offering me 10 to 1. And you can't make a judgment on that play. Even though 10 to 1 sounds enticing, you can't make judgment on that play because it's not giving you enough information. 10 to 1 is not really telling you anything, because I can give you 35 to 1 and you might say, well, 35 is better than 10 to 1. And then I take you to the casino and say, there's roulette, and that's a game that you don't want to play. And most people know that they don't want to play that game because the casino has the odds against them. They've added a couple of extra numbers. And so this is a big problem in the options, in the options arena, in the options education arena. They've spent $1 billion trying to teach the average investor concepts that are not needed to trade, just like the top guys in the world.
So how are they doing it? Like, well, what's different about are the can you give an example of how some of the top guys are?
Let's better with an example. We could take Apple. Pick a stock that you know. Well, you tell me a stock.
Yeah, all right. Yeah, I could share a chart. Let's see one that like today. Today was one that I was looking at, Alibaba, right?
Perfect. I love Alibaba.
Yeah, so let me share my screen. Yeah, and it'll be interesting to get your take on this and what I was seeing, and like how could we have done this idea better? So like the first thing that I was seeing, do you see the screen?
I see it.
Yeah, so what I saw was, and let me clear some of this stuff out a little bit. So what I saw was this consolidation here. Let me back up for a second. What I do is I'll start from the top. We have a monthly chart, weekly chart, daily. I have a 2-hour over here, a 30-minute, and then this down here happens to be a 5-minute chart. So I'll see what direction the market is moving in, and I want to trade in the direction of that market. This is one that came onto my radar over the weekend.
Okay. Why don't we? How about do this? Instead of going into that much detail, why don't you show me the chart of Alibaba? I have to. Let me ask you the questions.
Oh yeah, sure. So this is
put up the monthly chart, the daily chart of Alibaba. Go back. Let's go back a year. So I have 2 questions for you.
All right.
You think Alibaba is going to go up or down? 3 questions: up or down?
From this. So when I saw it like this. And I was betting that it was going to go up. Like,
all right, so you think it's going to breakout. All right, so you think it's going to go up?
Yeah.
Okay. Okay, that's a fair, however you thought about it, whatever you did, your process, that's what makes Mike different from the other million traders. Okay, what you do, how you find the idea, that's on you. So you think it's going to go up, and the next question I have is, how high do you think it's going to go? Where do you think it's going to go? What's your target stock price?
The target price for me was about 200.
200. And where was the stock when you were looking at it?
When I was looking at it, it was about 196.
Okay, so 196 to 200 in
Yeah.
Alibaba. I can tell you right off the bat, it's likely not an options play.
Okay.
So it's, unless you want to play the weeklies or the dailies or the, then it might be. But that's generally not how the top guys are using options. To me, that sounds a little bit more like a stock play. It goes from 196 to 200 is a $4 move. It's about 2%. So when the top guys in the world, when they look at options, they're looking for big movement. They're not messing around with 1%, 2%. They're looking for the trades where the stock's going to move potentially 10, 15, 20%. That's what they're looking for, okay? That's why if you look at any of their big portfolios, they might have 50 names, 50 stock names, right? But they only use options on 4 or 5. So the question you should be asking is, why only on 4 or 5 trades are they using options? Because there's an analysis being done. Because not every stock trade is an options play. And so when you come up with your idea, whatever it is, BABA, 196 to 200, whatever you're saying is fair. It's probably no worse than what the other 999,000 people are saying. What I'm saying, that's your idea, okay? Now, clearly, the hedge funds in the idea portion, they have edge as well. They probably have more edge than Felix and probably have more edge than Mike. Okay. Yep. When Steve Cohen comes up with an idea, he's got 10 different analysts looking at it. He's got consultants. So they have edge there. But once they're past that, once he has the idea, like you have the idea, he's looking for BABA to say, you know what, because I know the BABA chart. And BABA looks to me like it can hit 220. You get a Chinese announcement, you get something good. This thing hasn't moved for 2 years. I don't know if you have a year chart, but it hasn't really moved up and down, but it's been in this range digesting for 2 years. So BABA is something that these guys might be playing for a breakout. And if it breaks out, it's going to go probably to 230, 240. That's probably what the chart's going to tell you. Okay. So is 230, 240, is that an options play? Well, now you have to go to the next question. The next question is, because we have sort of if it breaks, it's going to 230, 240. Okay. Because it's been congested, consolidating for 2 years. It breaks, it's going to make its move. Why would it make its move? Probably for a China-US tariff deal. Okay, that may be, that's the move. Is that going to happen anytime soon? Well, maybe. December 15th is coming up. So now the move, the whole full move may not come at the point of the tariff, positive tariff agreement, but it'll start getting there. And over the next several weeks, maybe until its next earnings report, it might get to 230, 240 if everything goes well. That's the idea. Okay, so the question is 230, 240. Now, stock's trading 196. Where is it, 200 today?
Yeah, close to 200.
Okay, so close to 200. So 200 to 230, 240. Now you're talking about a 15 to 20% move. Now that gets interesting for a guy looking at it. Can I leverage this? First of all, how confident am I in this trade? Do I like this trade? How much do I like this trade? Okay, that plays into confidence. It plays into any probability game, and this is a probability game. So $30 to $40. Now what do you do? Okay, now you say, all right, well, the agreement, China tariff agreement, positive agreement, may not get it all the way up there right away, but maybe by the next earnings period, with that announcement, we could see it 230, 240. Okay, so now you have Alibaba into the next earnings period. What's that date? When's the next earnings? Probably in February?
Yeah, sometime in February.
Late January, February?
Yeah, let me see. Well, what's the date?
There you go, February 3rd, February 2nd. Okay, so we got until today, till February 2nd to get to 230, 240. Now what they do is they start doing this process where they're doing the risk reward on each strike, okay? The 200, first of all, they generally stay away from at-the-money options for reasons that I won't get into right now. But they're looking, what the best guys in the world are looking to do is to grab, remember, that limited liability function, that leverage. They want to be able to spend $1 and make $3, $4, $5. They got to balance how far away they want to be from the strike, from where it is, from the stock price, how far they want that strike to be away from the stock price today, and how much leverage they think they can get. That becomes the balancing act. Okay, so they will look at the 205 calls, the 210 calls, the 215 calls. They'll look all the way up, and then they start looking at the risk reward. They're not even looking at volatility yet. They might glance at it at this point just to kind of say, you know what, Alibaba's volatility, it's about 20 something, maybe it's 22. I don't even know what it is, 24. But whatever it is, it's not 80. It's not 70 volatility. So you know what? It's sort of a gauge. Anything above, let's have a rule, anything above 40 volatility, they might want to sharpen their pencils. But it's not their focus. Their focus is price. How much are they going to pay for an option, and what are they going to get back? Okay, so they look at the 210s and the February, I don't know what they are right now, you can look them up, but the February options, 210 calls might be $7, $8. I mean, you can look that up later, but call it $8. Okay, so let's say the February options are $8, $9, call it $8, $9. That means what? It's basically saying that, let's see, what is that? The 210s at 5% out. Let's call it at $7. Okay. So what they're saying is that at 210, the 210 calls is $7. If I think it's going to 230, okay, if I think it's going to 230, then what are those 210 calls worth after earnings? They're going to be worth at least $20, okay, and a little bit more because there's a little bit of time value left, just a little bit, okay? But they're worth $20, maybe $22. Okay, so I paid $7. If it hits my target at 230, I'm 15% higher. I make $23. Call it 25. 7 to make. I'm sorry. 210 to 230. 230 is about 23. So it's 23. 7 to 23 is about $16 is what I make. Okay, approximately what I make. At $16, okay, I paid 7. How much did I make back on my money? I made about 2 1/3 to 1, 2.33 to 1, right? So it's 17 divided by 7. I paid 7, I got back, I made 17, profit of 17. So it's about 2.33 to 1. The question is 2 to 1 good? Is 2.3 to 1 good? Right? That becomes the question. Remember, I told you, just because I give you the odds of what you're going to make, that doesn't mean that doesn't make it a good trade.
Right.
That's where the leap becomes. So your users, your friends here on this chat, what they need to understand is everybody walks into a casino and sees 35 to 1, and people say that's not a good bet. It's not a good bet because there's some math involved. It's simple math, but they added in extra figures, and the casino has the edge. It's not a good bet because over the long term, you're going to lose playing roulette. And people are comfortable making that statement and understanding that they don't want to play. What I want people to do, and this is a big leap for everyone who can do this, but what I want people to do is when you look at an option, or you're going to look at something, you're going to say, this option is going to return me 2 to 1 or 3 to 1 my money. I want you to then question whether or not that's good or not. Just like you would go to a casino and say, well, is that game good? Well, no, it's roulette, 35 to 1. That doesn't make it. So how do you do that? That becomes the next question. How do you do that? So I built brand new education to help people understand that process. How do you actually think about it? How do you actually figure out if 2 to 1 or 2.33 is good in Alibaba? Okay, and it has to do with probabilities and odds, but I teach the concepts. And then what I do to make it easy for people is I built a new options chain. And that new options chain essentially thinks like Steve Cohen. I made it think like the top guys in the world. So it does all the analysis. So what it asks of you is 3 things. Tell me the time, the expiration date. Tell me the target stock price, right? And then tell me your confidence level. Okay, how much confidence you have? Is people have trouble with that because it's hard to sort of pin down exactly what that means. But when you look at Steve Cohen's portfolio, he's only using options when he has, usually they're at the top 10 positions. So if, his top position right now, I think actually is Alibaba, okay, frankly. So I know that. So Alibaba being his top position means he has the most of his money, or a highest percentage of his money is in Alibaba. Okay, that means he has high confidence. It's showing you that that's his number one position. He has high confidence in Alibaba. Okay, so he might look at options in his top 10 positions because he has this high confidence of where he thinks it's going to go. The market has it mispriced. He knows something that, his analysts have uncovered some advantage or some edge or some, fundamental analysis that says, you know what, they're going to do all right this quarter. Okay, that makes it a top 10 position. So that gives it confidence. But you need confidence on the upside, but also in the analysis on the downside. Does this have an opportunity? Can BABA go down a lot? Mm-hmm. Right? It has the opportunity, we've stated, to go up, but can it go down a lot? Well, if there's no China US deal, BABA could get hit pretty hard. So that starts making it a good risk reward opportunity. I can risk, let's call it the 215s at $5, $4. I can risk 4 if it gets to 230, 240. I'm going to make 4 or 5 times my money. But I think that the risk reward is balanced in this way, and so that's what I teach. Okay, that analysis. That's what's going on. It's basically, if we were going to play, just to make it even simpler for you and users, if we're going to play heads or tails, and I said, Mike, if you hit heads, you look like a guy that can hit heads a lot. So if you hit heads, I'm going to pay you $1. But if you miss heads, because you look like a guy can play heads, can hit heads a lot, you got to pay me $1.25. Okay, because I know you're going to hit the heads a lot. And people are not fooled by that game. Okay, you're going to say, I'm not playing that game because I will lose over time. Okay, right. So the question is, how did you do that analysis? How did you figure that out? It's simple. It's a simple math formula. It's called mathematical edge, but it's a simple math formula where you would basically, take one side, positive expectancies and negative expectancies, which are 50-50%. You would weight them, and whichever side is greater, positive or negative, that's what would tell you to play or not to play. Okay, so I teach options using that formula, and it's easy. It's easy to understand. It's not easy to do a million calculations, so that's why I built a tool to help people do it for them. And then the tool actually picks, given your view, given I think Alibaba is going to go to 200 by, let's call it December expiration, right? December 20th. So I think Alibaba is going to go to 200 by then. And should I use options? Well, you would plug in December 20th. You would put in 200. You would raise your confidence level to say, I really like this, maybe 80, default at like 80, 90 for an options trade. And it would pick out an option or it wouldn't. I'm going to tell you because I can just tell that on a 2% move in BABA over the next 2.5 weeks, probably not an options play. Probably not an options play. And so, and one more point to make to avoid the confusion. When these guys buy options and they're going to spend $1, and I use $1 because it's just easy math. Yeah. If I called up one of these guys and said, I got a great idea. We're gonna spend $1 and we're gonna make 50 cents. We're gonna spend $1 and we're gonna make 50 cents, right? They would hang up the phone and tell me, you don't understand what you're talking about. You don't understand what we do here. And they would hang up the phone, okay? So it's important. It's very important to understand that $1 to $1.50, that's a 50% move. They don't care about 50% moves when they're using options, okay? When they're using options, they are targeting 150 to 400% returns. That's the only time they're using options, okay? So if you can have that understanding now, and we can go into what I do, which is I talk about unusual options activity, unusual options volume, okay? A guy like John Najarian has made it famous. Okay, Najarian has made it famous by focusing on the stuff. And I got to tell you, it's valuable. It's valuable. He's not the only one doing it. People have been doing it for a long time. I was doing it for a long time. How did I learn to do it? Well, you're talking to the top guys in the world. You know what the top guys in the world, they want to know? They want to know what the next guy's doing, right? So guys like the traders at Steve Cohen, they're calling me up and going, what are you seeing out there? Well, when I'm standing at Bank of America, I'm seeing a lot. If I'm sitting at Goldman Sachs, I'm seeing a lot. They want to know what everybody's doing. What's this guy doing? What's that guy doing? So what John Najarian has been doing over the last 15 years, that's what myself and many others have been doing for the last 40, is really piecing together who the big guys are, where they're moving money to, and how fast they're doing it. So for example, Raj Rajaratnam, I don't know if you know that name, insider trading guy. I traded against him a lot at Galleon. He was a big trader, big options user. Okay, he would come in. He comes in to buy Micron. Steve Cohen comes in to buy Intel, Micron. Okay, somebody else, Soros trader comes in to buy semiconductor calls. Which way do you think the semiconductors are going? Probably higher. If they're all buying calls, probably higher. Why? Because somebody's got the inside beat on what's going on. And you know what? 10 years later, I realized they really did have the inside beat, right? Raj Rajaratnam really did have the number, right? But they're coming in and they're buying, these call options. So, when three of the biggest guys are buying calls in a particular sector, well, as a person who sits at Bank of America, I'm going to call up another hedge fund guy and I'm saying, I want to let you know that some smart guys, some big money guys are buying calls in the semis. What are you doing? What are you looking at? And they tell me, well, you know what? We like the semis here. We're hearing that Intel's numbers might be good, or they're raising. These guys are talking to consultants. We're hearing that the factories are producing more. People are walking out of factories, after 24-hour days and telling you that they can't stop building the chips fast enough. Okay, so they're getting wind of that. Numbers are going to be good. They come in and start leveraging calls because earnings are going to be good. So when you start seeing, and when they're getting that sort of like feedback from their consultants, that's information that's live, that's not really disseminated to the street. And so that's when they feel like they have that edge. That's when options might work, because a stock like Micron might be trading down for 2 weeks and all of a sudden you start hearing these factories aren't producing chips fast enough. This stuff might, Micron could just shoot up. And so do you want to buy stock? Sure, they're probably buying stock as well, but they're buying stock and they're leveraging up with options. Okay, and they're not looking to turn a dollar into $1.50. They're looking for that dollar to turn into $3, $4, $5. Otherwise, it's not worth it for them to buy the options. They just buy the stock. So it's important. It's important. I see there's a lot of people that I ask them what's their process, what they're doing, how they're doing it when they're buying options, and people are quick to take a 20-cent gain. So I paid $1, took 20 cents. It's $1.20. Oh, okay, that's one way to do it. It's not the way the big guys do it. That's really day trading options, and that's hard. That's not an easy game. That is not an easy game. Can some people be successful at it? Sure, but what the big guys of the world do, the top 1%, they look for specific situations, very specific, and when they find those situations, they ask themselves, "Is this an options play? Yes, it is. Which one do I choose? This one. Why do I choose this option? Because it gives me the best risk-reward chance of winning."
How far out with the options do they typically go? A couple of weeks?
They'll typically go over some sort of event. What these guys are looking at is they're looking, because timing is an issue, right? When you're buying options, timing, you just don't want to be sitting there with an option, right? What these guys are doing is they are targeting a specific date or a specific event, an FDA meeting. Right now, the hottest thing in options right now are these biotech options. They've been trading all day, every day. And you're seeing in the last month, you're seeing some of these biotechs up and down 100%. There was one today down 50%. Sage, there was another one yesterday up 100%. These are options plays. They're options. Why? Because they're having big moves. And so what these guys, the timing for these guys is, it's not specific. It's really they're looking for something they're looking for an event that will move the stock. Okay, they're looking for an event that will move the stock.
And that event can be in the range of, say, a week or a couple of months. So, is there
usually, yes, usually I would say it's about six weeks. But it could be as fast as, you can't say, look, it could be as fast as they come fast and furious on like snap calls a few months ago, and they were buying them every day for a week, and it was, the move happened in 2 weeks. They were buying 3 week options. So they go where the they go where the money is, or where the event lies. They go, if the event's going to be in a week and a half and they get good data, or they get good information or good analysis, or it's just good risk reward, they'll go for that event. But usually, and the trades I pick for the Options Geek community is 6 to 8 weeks. That's about the usual time period. It covers a period of time. It covers an earnings date, or an FDA meeting, or an analyst meeting, or any type of meeting, okay? Sometimes I'll choose an option for the community to trade that doesn't have an event, but sometimes a lack of information is the information, if that makes any sense. For example, someone comes in and buys a 3-week option, and you look and there's nothing on the schedule. There's nothing. They bought 15,000 calls of an option of a stock that has no earnings, that in 3 weeks has no announcement of an investor analyst meeting, have no FDA. There's no event. So why would they buy 15,000 options of that stock over 3 weeks when there's no event? Why are they doing that? So one thing that, to go to the next level of what I do is, I'm not just picking trades for the Options Geek community and giving them trades just because it's unusual options activity. So what unusual options activity is the end of a long chain of events, right? So when you see something, or something pops up today and it says that's unusual option activity, first, there's probably 150 of them each day, okay? So you're not going to trade every single one. Second, how do you then analyze which ones are good and which ones are no good, which ones will work and which ones won't work, right? And these are the problems that, unfortunately, people have come across, because Nigerian has made it famous, unusual options activity. Just look at that. That's the big money guys. That's what's going on. But there's 150 of them a day. So now how do you filter them down? How do you analyze them? And then once you analyze them, how do you actually know what the person was thinking? How do you know what the hedge fund guy was thinking? He did this trade. Is it because of this, this, or this? So my experience is in the stuff you don't see, right? What I'm explaining to you here, how the process, I worked at a hedge fund, so I understand the process of coming up with the idea, how they come up with the idea, how they then decide to trade the idea, how the trade is actually, how the trade goes down, how it's actually traded in the market, right? That gives you clues. Who traded it? Bank of America, Goldman Sachs? Did it trade through the machines? These are all different, crumbs of, it's like a detective, they're little crumbs.
And we could see that too, as on the retail side, like who's placing the order.
You could see that now. Yes, you could see a lot of it, but nobody's taught you how to analyze it yet. So that's what I do. I help people learn how to analyze the breadcrumbs to put the pie together and say, that's a good trade. That's a good, that's a good trade for such and such reason.
Awesome. Where do people go to get that?
So I built a site based on 3 parts. I built it on, I wanted to found, I'm a big believer in education. I'm a big believer in understanding, in, not just doing something because someone else is telling you to do something, right? So I'm a big believer in helping people, encouraging people to learn what I know. It's going to take a little time, but I provide education. So at optionsgeek.com, I give you education. I give you a tool. So once you understand the concepts, then you can do it yourself. You can start thinking about options just like the top guys in the world, okay? So you have the education, the tool, those go hand in hand. And then the last part is, okay, well, now that you have this education, now that you understand a lot of what we talked about, but I go into detail in the education, you understand. Now I want to use the tool. I use the tool. You can use your own ideas. Mike could use his own ideas. Anyone on your site can use their own ideas, or I can give you ideas. I can give you my ideas. And you there?
Just to show people what it looks like.
Sure. So basically education, the tool, and then I give you my ideas. And I can tell you that, people, when they join, they think they could do it themselves, but I think they see the difference. They see the difference between my ideas and their and sort of the way they're picking. And it just comes from experience. But within a little while, you might be able to do it yourself. And ultimately, if doing it yourself is what you want to do, I'm all for it as well.
I think that's fascinating. There's a lot of questions coming in on the side
Yeah,
over
I'll
here.
answer anything. Let's go through anyone. Go ahead.
Yeah, let's see. Yeah, whoever has questions, like pop them into the chat, or if you want to talk live, let me know and I'll unmute you and we'll take your questions. But let's see, just to scroll through some of what's there already. Jeff says, takeaway here is they are not using options as stock proxies, have a specific purpose to capture specific events. Yeah, right?
I didn't hear. What is he saying?
So it's, they have a specific
Takeaway here is that they are not
purpose.
using options as stock proxies, have a specific purpose to capture specific events. Yes, I would say yes, they do that. The question, the question that Jeff should have is how do they actually go about doing how do they go about executing that what he just said? How do they actually go through the process of picking the option? Once you have the event, how do you know of the many strikes? How do you know that's the right one? That's the main question. That's the hardest question in options. That's a question that you can't find an answer to anywhere. So people ask me, well, what makes your education different from anyone else's? What makes you different? What makes you unique? I tell people, you could spend 100 hours. Go spend 100. I'll give you 1,000 hours. 1,000 hours to go learn whatever anyone else is teaching you. And at the end of the day, you're going to ask a simple question: which one do I buy, and how am I sure that's the right one? And you're not going to get a straightforward answer from anyone. So you'll come back and ask me the same question, and that's the truth.
I think this question from Anthony is real interesting. Well, what is your opinion on using options to hedge a position, such as puts over earnings?
Same thing. Puts or calls, same thing. Where do you think it's going? So puts are obviously are bets to the downside. There's no problem. The big guys do use puts to protect over a period of time. If their analysis says we're long this and we think this is a shaky quarter, and if it's wrong or whatever happens here, it could be catastrophic. So absolutely, the big guys are using puts to hedge over earnings. But they have specific, again, it's a very specific reason. They won't do it unless I would say one, there's tax reasons too, right? Which we won't get into tax reasons, but if it's held under a year and they don't want to sell it, they want to kind of get towards the year to reduce their tax burden. They may just buy puts. But if they actually are worried, they might consider selling the. There's nothing wrong with selling the positions, but some guys are just long stock. They don't want to sell it ever, and they'll come in to buy puts. So there's nothing wrong with it. They do absolutely come in to buy puts over earnings while owning the stock. Yes. One question there. I think I see one. Do you sell premium to pay for your option purposes? I do not. And I can tell you that most guys, there's a couple of strategies that are actually that are decent strategies, and it gets a little bit more complex. But the top guys in the world, they keep it so simple. It's almost laughable how simple they keep it. They buy puts if they think it's going down, or they buy calls if they think it's going up. And what's not simple is how they got the idea and the analysis to get the idea, to figure out where it's going, and why it's going to get there. And what's not simple has not been simple until now is how do they actually choose? How does someone choose which option they should pick?
So how about like any of the like spread strategies or anything like that, right? Like the buying or like selling like a calendar spread or that stuff. Like, do they engage in any of that kind of activity at all? Or
I would say 90% of the time, 90% they're buying puts, buying calls. The other 9% they're doing maybe a put spread or a call spread. Maybe they'll do it. They'll do put spreads, call spread once in a while, but 90%, 9%, and then 1%, they're gonna do maybe some like butterfly or something like that, or it's like the $2 yen on the craps table. It's just like, this isn't what we really do, but you know what? It only costs a quarter. I'll do that butterfly, and maybe it turns into 50 cents, 75 cents, or $1. But
Mm.
90% of the time, they're buying puts or buying calls. You know,
So-
Mike, I said this to you the last time.
Yeah, yeah.
When you have kids,
Yeah, I've got a daughter.
daughter. Okay, so I have a son and a daughter, and I tell my son we're playing baseball out at the park. When I start talking to him, I said, listen, I said, ultimately you're gonna have to pick a team. I like the Yankees. You can pick whoever you want. Of course, he hates the Yankees, and then he says, no, I want to be the Red Sox. Okay, fine. I said, look, I said, if you want to be a good ball player, you know, when you're watching the games, I want you to watch the best guys. Watch the best guys, because they didn't become the best guys overnight. There was a lot of practice. They got a good swing. They throw the ball a certain way, and they do the basics very well. And they practice a lot. And I tell them to watch the best guys. My daughter, you like swimming? Go to the Olympics. Watch the best women swimmer, right? Watch what they do. What do they eat? How do they train, right? In options, why would you not watch the best guys in the world and how they do it and what they do? So, you know, at the end of the day, do they mess around with these other types of trades? 1-2%, you know, a couple of guys, you know, they get sold on an idea and say, oh, you can, maybe. But 90% of the time, they're looking to come in, buy a put, buy a call. The question always was, throughout my whole career, was why now and why that put or why that call? And you can't find that answer. And that's their secret. That's what they knew for a long time. And I've backed out. Just from being around them, from executing against them, trading against them, being at the hedge fund, sitting right next to them. They didn't spell it out for me. This is how they did it. It was just over years of listening to them and hearing what they're doing and them yelling at me. I'll give you an example.
All right.
Get to the hedge fund. The first week at the hedge fund. Now, I went to Wharton. These guys went to Wharton as well. I went to Wharton. New options, like I know options back of my hand, volatility trader for many years at the highest level. I walk in there and I wanted to, you know, make my mark right at the beginning. They essentially hired me to be the expert. First week, he says, buy 5,000 of these calls, pay $1.10. They were $1 on the screen. He goes, I'll pay up to $1.10, buy 5,000. Okay. So I have like 5 screens up. I'm looking at everything. I'm seeing, you know, trying to figure out whether $1 is cheap, $1.10 is expensive. What's going on? I go back to him and I said, yeah, what's fair? I'm looking at Vol. I'm looking at the Greeks. I'm looking at a million things. I said, boss, it took me a couple of minutes. I say, boss. He goes, yeah. I go, these are too expensive. So he paused. He actually turned around his seat and he just looked at me and he said, what are you talking about? And I said, they're too expensive. And I could see him getting angry, but it was my first week, so I don't think he wanted to get so angry right away. But he said, what would be cheap? Let me ask you. He said, I don't understand what you guys do, but what would be cheap? And I said, well, I think 97 cents would be cheap. At that point, it was like he was starting, like smoke was coming out of his ears. He was starting to shake, like, and he's like, so let me ask you a question. I asked you to buy 5,000 options at $1.10, but you did all this analysis that you and your friends do, and you're telling me that you don't want to buy this option because you think it's worth 97 cents. And I said, yes. And he said, if you ever say that again, I'm firing you on the spot. And I was like, okay, like, all right, what do you mean? I just left a big job. And he said, you're telling me, let's put it in layman's terms. You're telling me that you're going to miss this whole trade. I think that $1.10 is going to be worth $3, $4, $5. Okay. I think it's going to be $3 to $5. That's what I think. And you're telling me we're going to miss this whole trade because you come up with some model that says it's 13 cents too cheap. I'm sorry, 13 cents too expensive. And I said, you know, as he was saying that, I'm thinking to myself, you're right. Like, that sounds stupid. Right. Mm-hmm. And I was like, yeah, you're right. And I never made that mistake again. I understood very quickly from day one that it was about risk reward. It wasn't about implied volatility and the Greeks. It wasn't about all that stuff that you learn on one side of the fence. So, you know, that was a first week on the job, and he made me feel so stupid, but it was a great learning experience. I was willing to miss a whole trade for 13 cents as opposed to him saying just buy for $1.10. It's not going to matter. It's not going to matter. It's either going to be $0 or it's going to be $3 to $5. That's a big lesson. It's a huge lesson.
I love it. And I think that fits in beautifully well with a lot of what we do on our end too. Like everything is about risk reward, R multiples, looking for 3-to-1, 4-to-1, 5-to-1 types of trades. And this is like a
Very
great
similar.
way.
Think about stocks. I mean, most people do with stocks. Like the probability of a stock going up or down and at any given moment is probably about 50%, right?
Yeah.
It's going to go up or down about 50%. But if you can find situations where you think it can go up, you know, you find a level or technical level and you think I think it can go, Baba could go up $4. Okay. But you know what? There should be buyers at around 194. Okay. So now what type of trade is that? That looks like, all right, well, if it breaks 194, then the buyers have disappeared and it probably goes a lot lower, or at least a few dollars more lower, but it'll give me an opportunity because there's support at 194 to give me an opportunity to actually get out. Okay, so my stop's going to be 194. But if the stock starts moving higher, I'm going to ride this to about 200 and I'll get out right around 200. That's about a 2-to-1 play, right? $4 on the upside, $2 on the downside, and you're kind of basing it on a 50-50 up or down. That's a pretty good play, you know, for a near-term play. It's sort of the way people should be looking at it. I'm just simply trying to take that analysis and incorporate it into options. And nobody's really done that. No one's done that, and no one understands that just yet.
Yeah, no, I've been trading now for 20 years. I've looked at a lot of different options material, education from a lot of different people. Nobody has explained it like you have. Like,
it's incredible. It's incredible. Let me tell you, you know, there's a reason why the industry is focused on the Greeks and implied volatility. And it's very simple. Options education a lot of it came from O'Connor, where I worked, okay? And the people who are teaching options education are generally former market makers. The OIC, which is the industry, the Options Industry Council, they are former market makers, okay? So market makers are teaching you options education that they created, which is basically their version of options. And I can tell you that 99.5% of the people in the world don't trade that way. So think about what I'm saying. Options was created by market makers who make money in a different way than the 0.5% of the people, than 99.5% of the people. That's only a small part. So the education was created by them. It's taught by them. The material is all based on how they would actually make money, which is on the Greeks and implied volatility. I was a volatility expert. I did trade volatility for many years. Yes, the Black-Scholes model is relevant. Those books, all those books, they're relevant. Okay, that's how you trade volatility. But 99.5% of the world are not trading volatility. And when I say trade volatility, because people get confused by that, trade volatility means you're not trading the direction. That means you're consistently delta hedging your positions, which means you're taking the direction out. So when Steve Cohen would come to me at Bank of America and say, I want to buy calls in Micron, he's trading direction. He wins if Micron goes higher. How do I win? Well, if Micron goes higher, I can't tell you if I'm going to win or lose, okay? Because you haven't told me how Micron's going to get there higher. Is it going to move really crazy, or is it going to move sort of in bite-sized, moves it all the way up? So it's possible, it's very possible that I could win trading volatility, and Steve Cohen could win buying those calls because the stock went up, trading directional leverage. We both could win, which is the beauty of options. So I traded volatility. A guy like Steve Cohen, they're trading direction. That's the difference, okay? Education was the stuff I was learning. The stuff that's out there about all the Greeks, that's the stuff I was learning. It's not necessary to trade. If you want to trade like the best guys in the world, they're not using that stuff. They might look at it for a quick second, but it's not like they're not looking at their Vega. They're not looking at their Gamma. Maybe their delta, as far as what's the delta of the trade, just to kind of figure out how it's going to start moving early on. But that's about it. Implied volatility, they're not doing analysis. They're not trying to, in order to be a good volatility trader, you need a forecasted volatility. How is anyone who's on Robinhood, TD Ameritrade, how are they forecasting volatility? I mean, you got guys like Citadel, D. Shaw spending hundreds of millions of dollars trying to forecast, S&P volatility over the next 30 days. How is anybody going to do that? They don't have the tools to do that. Okay. So volatility is just a number. It's just a number that comes from a formula. I've said a lot here. I said a lot, but what at the heart of it, the education that's been created, all the education that's available, that's out there, okay, is misdirected. Okay, it's not for the traders that everybody is out there trying to be. People are out there trying to figure out what's going up and down, and they're going to use options to give themselves a chance to win if they find a position that can go higher. So what you're looking for is you're looking for big moves, and you're looking for good risk reward. The question is, how do you actually do the big moves? You can see in charts. The question is the options process. How do you know when that's the right play, and then which one do you choose? And that's really what I teach. And it's simple. It's I have easy to understand concepts. I think it's enjoyable. The testimonials are great. People love it. I asked you whether you liked it. You were blown away by it. So people love it right off the bat. And I'm proud of it. I'm proud. It's really, right now, it's me against an industry. The industry has spent think about how much money they've spent building everything out. And now I'm here telling them it's not you don't really need all this stuff. You don't really need all these big tools that nobody uses, these big, skew trades. It's not necessary.
It's wonderful, and the tool is fantastic. Just to be able to like pop in the ticker, put in your target, and it just tells you it's just so crystal clear. Like, do you use an option on this? Yes or no. Do you have a mathematical edge? Yes or no. Right. And
it's what it does is it gets everyone to do what they're supposed to do. People shouldn't be trying to analyze options, right? There's computers to do that. That could be done already, right? And so what people should be focusing on is what I asked you. Where do you think Baba is going? How high do you think it's going? What time frame do you think you need? Mm-hmm. And then what does the risk reward look like? That's what people should get back to, looking at the stock. People are not, everyone is trading options. They're not options traders. Everyone is a stock trader that sometimes uses options. Okay? Everyone is a stock trader that sometimes uses options. People are not, when people say, I'm an options trader, and I say, when someone says that to me, I say, like a real options trader, or like you use options to get leverage? No, I buy calls because I think it's going higher. That's not an options trader. Not in the sense of Wall Street, right? When you say I'm an options trader on Wall Street, I was a derivatives trader on Wall Street. That was considered, oh, you're an options trader. A market maker was an option. These guys are trading volatility. Guys who are using, options because they think the stock is going up, which is 99% of the world, or puts because they think it's going down. They are stock traders that are using options for the limited liability, for the leverage. Mm-hmm. And if you're selling options, which people say, oh, you only talk about buying. I only talk about buying because the best guys in the world, that's what they do. Minus a few of the big guys like Warren Buffett, who trades once every 9 years on an S&P put. The biggest guys in the world, they buy, and they buy for that limited liability. It's that simple. Now you just have to understand the risk reward analysis. That's really what it's about.
That's great. Where can people, I want to be sensitive to your time too. You've been with us for an hour.
No problem. We can come back. People have more questions after they watch your video, the tape video. They might have more questions. I'm happy to come back, but they can reach me even directly if they wanted at felix@optionsgeek.com. And, or they can just go on Options Geek, and there's a bunch of, optionsgeek.com has a bunch of good starter material. I give away a lot for free, just to get people going and get people to see what it's all about.
Awesome. Yeah. There it is again. Yeah. Optionsgeek.com and everything, all the Facebook, Twitter, YouTube, Instagram. You're everywhere.
Trying to be. I think right now I'm focusing, I focus a lot on this path, right? The path is education, tool, brings it to practice, brings theory to practice, and then trying to get people down that path to profitability, giving them good trading ideas or showing them how to get good trading ideas themselves. So I allow them to, I want you to get educated. And then if you want to do it yourself, do it yourself. But I have good ideas, good trading ideas. I offer that. And the results have been phenomenal over the last 6 months. I went public in March, and right off the bat, March was, and I showed people the results, 60%, up 60% in March, and up 154% in June. So those are big numbers. It's not going to happen every month. In April. April, we caught the APC takeout. So guys, my members made 10 times their money on that trade. They've been we caught the Ameritrade puts on the way down. Some people made 7 to 10 times their money there. So I've really gamified. I've tried to gamify options. I made it easy for people to understand, and then turned it into a game. And I explained the game on the site, and I show people how we play it. But essentially, it's 10 to 15 trades a month. We're trying to win on 30 to 40% of those trades. But when we win, we're trying to win 200 to 400%. Okay, if you do the math, simple math, you can make a lot of money.
Yeah, absolutely. This has been great. It's been extremely eye-opening.
Good. If you have any questions, anyone has questions, I give a lot of time to people with questions, more time than I should, to be honest. But I'm happy to go over things and answer any questions. Feel free.
Thank you so much, Felix. Really appreciate you.
Thanks a lot, Mike.
All right. Take care. And thank you, everybody, for joining us.